Holy moly, the stock market is really upset today. And you know what? It quite frankly should be, because there are a few things that are re-exciting people's inflation expectations, and in the near term, it's obviously going to lead to more volatility, especially, and it drives me nuts when you see this kind of stuff. You guys remember Bullard, right? What does that make you think of? Mr. Bullard. Oh, you think he's at the Fed, right? No, he quit from the Fed. He quit to go be the dean of some school. And guess what? Today, we get headlines. Bullard suggests additional rate hike. Based on recent data, Bullard suggests Fed should hike again. It's like, bro, don't even work there anymore. But it's bearish, so gotta use Mr. Bullard on the headlines. But no, look, there are some things that are creating at least some heart palpitations on the inflation side, and this is normal. Nobody expected this to be straight down on inflation. Most specifically, oil. Oil is creating some real issues because oil is not just that headline energy read, we get inflation. It flows through to everything. It makes trucking more expensive, shipping more expensive, commuting more expensive, plastics more expensive. Everything becomes more expensive when oil goes up. And quite frankly, we've had one hell of an oil rally over the last few weeks. We're at almost $90 a barrel now on Brent. We did break 90 for a hot minute, but we have been basically straight up since about June 29th. Then you get to July 19th. We kind of had like a little pause, and then it was straight up from July 19th. Guess what else was straight down from July 19th? Well, pretty much stocks. They've had a little bit of a recovery mode because oil fell again. Now it went to new highs. A lot of this has to do with people's expectations for inflation. And anytime you start screwing with people's expectations for inflation, the market almost algorithmically trades like this. And it probably honestly is all algorithms. Like, I really doubt people are waking up, in the morning going, well, ISM services a little hotter than expected. Time to sell. Like, this is totally people who last night are like, all right, let's program the algorithms. Okay, if ISM employment and prices paid comes in high, let's just go ahead and set it up. Sell risk. That's all this is. It's the suits, and in honor of those, to just demonstrate it, I wore a suit. No, I actually have a Zoom meeting, so obviously I'm naked on the bottom, but they don't need to know that. Anyway, obviously the suits are doing whatever they can to take advantage of this volatility and make money. That's what they do. That's what traders do. That's what hedge funds and institutions do, especially to rob money off of retail. And that's okay, because if you long-term buy and hold, that's great. If you're a trader, great. Then you use this data and you're like, perfect, give me more. It doesn't really matter what you are or how you want to make money. That choice is yours. So what data came in this morning, and what the hell did it do to us? Well, it was ISM data. Okay, so we got Institute for Supply Side Management, and this is services data. Services data for August. Now, the services index came in a little hot at 54.5 versus 52.5. Fine, that's relatively benign. The problem was the prices paid level rose a good chunk. We went from 56.8 to 58.9. And that prices paid index does actually relate to the services component of CPI. It's one of the things that economists use to make their projections for CPI, which isn't great because we'd really like CPI, especially services, to start chilling out a little bit. Services, though, now, despite this ISM, the current estimates for CPI month over month on September 13th are 0.5. That's up from 0.2 last month, and most of that is because of oil and gas. And then core still expected to come in at 0.2. So we haven't seen a disanchoring yet here of those expectations, though the market's kind of like, trade it, trade it, don't hold it, trade it. Now, it is interesting that this comes the day after you get Nick T, our famous Fed watcher and leaker over here from the Wall Street Journal, saying the New York Fed's inflation gauge that attempts to capture the underlying trend of inflation, called multivariate core trend, falls to less than 2.8% in July. June was revised down as well to 2.8 from 2.9. This is the lowest reading since January of 2021. And a way to see this a little bit better is just zoom in on the blue line. You can see that there is volatility in even the multivariate core, but it's been rapidly falling. Today's ISM numbers did not move the 5-year break-even, though the 5-year break-even is sitting at 2.26, a little hotter after the labor read last week. And the 5-year forward 5-year break-even, basically 5-year break-even, how much inflation we expect over the next 5-year forward is going forward, the next 5 years after. That one actually fell after this morning's data to 2.23. So the numbers come in all over the place. Like this is not a surprise. What is also not a surprise is AMC dumping on shareholders. We saw that happening from a mile away. So that's not a surprise, and that's why AMC is tanking. And guess what? I promise you, and this should just serve as a warning, every single freaking time AMC goes up, whether it's on Taylor Swift, Hopium, or whatever, I guarantee you they are going to dump stock. Well, I shouldn't guarantee that because, like, I'm not them. I can't guarantee that, and don't sue me, bro. I'm just trying to give you a heads up. Anyway, Fed terminal rate now sitting at 5.46. Markets are pricing in a little bit of an increase for having one more rate hike now. If we look at the terminal rate monitor and we get a little bit of an estimate of how things have changed over the last day, we're still looking for that pause in September. But the numbers on a hike in November did move up about 8% from 38% chance to 46. Honestly, right back to a coin toss. This is really not that big of a surprise, but it is leading tech stocks to sell off, risk stocks to sell off. This is not a surprise. Markets are really ready for the Fed to be done with hiking. And until the Fed is done with hiking, I don't think it makes sense to actually, for most traders, to buy the 10-year treasury. Maybe you buy 2-year, or honestly, if you're going to buy the 2-year, just go into money markets. But I think for most traders, it probably makes sense to wait to buy the 10-year treasury until you know the Fed is at a ceiling. Because once the Fed is like, we're done hiking, well, now you basically have a license to buy that longer duration part of the curve, which is otherwise more subject to risk in the event the Fed keeps going with higher for longer stuff. So as soon as the Fed is like, we're done, treasury yields on the 10-year probably, and probably not the 2-year yet because you're too similar to the money market rate, but the 10-year probably comes down. But the Fed doesn't really want the 10-year to come down yet because if the 10-year comes down, they loosen financial conditions, which they don't want to do. So they're purposefully manipulating the yield curve to stay inverted the way it is and keep that 10 as high as possible. Honestly, if it weren't for this Fed's talk, it could be even higher if they just stayed higher for longer. But this talk about potentially raising even more keeps that 10-year yield higher because people are like, okay, maybe I'm not going to touch it just yet. Maybe I'll wait. Because remember, if you're an institution like a trader, a hedge fund, or a money manager or whatever, people are going to be like, why are you buying this crap? That you have to answer to your clients. So it's a little annoying. But anyway, look, the bottom line out of all of this, congratulations, we got some inflation volatility, at least in some of the data. That's what we would expect. We would expect to have some of that in this sort of market. It's not going to be a straight down. I don't think this fundamentally changes anything, and I'll see you in the next one. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.